Okay, so this is your predetermined overhead rate. And so now every job that occurs, we calculate how many machine hours that job took, and we multiply it by 9 to figure out what the overhead is. That's how it works. And that goes into, going back to my T account, that's credited into applied overhead. Debited to work in process. That's how it works in practice. Okay, so we do that, excuse me. And what's the next question? The next question is, during the year 500, so a specific job, 500 was started and completed. So the following information was available. Direct materials was they tell you, direct labor, and how much would the overhead be?
30 times the 9.
Exactly. 30 times 9, that's the overhead. Then we've got the complete,
Add it to the direct.
then we've got the complete
Materials.
product cost. Only manufacturing costs. We're not throwing in marketing, we're not throwing in, and it gets confusing because we mix in, we've been talking about variable cost per unit, and I know that does include things like selling and administrative, but we're strictly focusing now on manufacturing costs. No non-manufacturing costs are being thought about here. So let's look at the answer. $9 per hour, then we're going to basically, and you should have, the job was $850, right? Good. And now they want you to calculate the over and under applied for the whole company, which consists of many different jobs, not just this one. And how did you do that? Well, that was number 3. They told you that during the year, the company worked a total of 147,000 machine hours on all the jobs and incurred actual overhead of $1,325,000. So go back to my T accounts. You had basically, you have actual overhead. This would be actual. You have applied overhead. So we know the actual overhead is how much?
147. No.
Oh no, sorry, that's machine hours.
The actual overhead is 1,325,000.
0, 0.
Right.
And what's the applied overhead?
1,323,000.
0.
And we know this is equal to the actual hours, machine hours times the $9 per hour. How many machine hours were there actually?
147,000.
So this equals 147,000 times $9 per hour, and that's how we got that. So basically, we need to reconcile at the end of the period these temporary counts, and in this case, the actual is over what they put in. So the difference is going to be underapplied. They put in only 323 into the cost system, into the actual inventory. They should have put in 325. So what do? We reconcile it, and the difference is ultimately 2,000 fell short. That's going to be, we're going to basically, if you do the journal entry I did before, you're going to end up debiting cost of goods sold 2,000, which is increasing it. Because and to prove it, debit this, zeroes this account out, credit this, zeroes this account out, and the difference you'll see is a debit to cost of goods sold. Meaning, it was, so you end up with was it 2,000 guys?
Yeah.
So this is $2,000 under applied. Okay, so again, I leave this to your own exercise. Debit this for this amount, credit this for this amount, and then you'll see the difference is a debit to cost of goods sold, which increases it. Very good. All right, so we're done. You see, you clearly understand the rudiments of this chapter, and now I've assigned you a problem which takes you a little bit away from the overall plant-wide rate into departmental rates, and which is a little more sophisticated system. Gives you a little more accuracy. Okay, so I'll leave that to you. Okay, let's move on now to our next chapter, which is chapter 5. Before I move on, guys, any questions on chapter 4? Again, the nice thing about having a nice small group is we can ask as many questions as we want. Feel free
Face
to.
to face,
any-
in person.
Yes, I like it. I prefer it. It was very hard.
So do we.
I prefer, it was, you don't know how hard it was trying like this.
Yes.
For me, I was like tearing my hair out. It was like,
I
I
could
don't
feel
understand. I don't understand
fuming
it.
and
I don't understand.
fuming.
I was like this. What do you mean you don't understand? I can't. It's hard for me to talk over the phone because I'm very. I like to go to the board. I like to act. So I was like running around the room. I was trying to show you something, and I knew you couldn't see anything. So. Okay, that's all right. So we're going to move on now. But in chapter 5, we've been focusing on this idea of the contribution margin. We've talked a lot about that, the so-called contribution margin income statement, which focuses on, it's based on the behavior of cost, not the functional description of cost. Just as a brief review, last semester we looked at the traditional income statement, which has things like cost of goods sold, selling, general administrative expenses, broken out in their functional categories. So you have sales minus cost of goods sold equals gross profit, minus the selling general administrative expenses equals net income. That was the basic. But that's not the way the managerial accountant likes to look at the world. They prefer you take all these costs and expenses and break them up into the behavior. So in other words, now we have this so-called contribution margin statement, which is a nice statement for planning, controlling, and for decision making. Because you're taking sales minus variable costs now gives us contribution margin. And that's something that is an economic concept. That's how much additional profit those units are providing in order to cover fixed costs. The way the management accountant looks at the world is we can't avoid the fixed cost, so how many units do we have to sell, each one contributing a little bit of contribution margin to get over the hump, to cover those fixed costs. That's the way the contribution margin statement appears. So therefore you have you have two different statements. You have the one that we learned last semester and the one that we're focusing on this semester. Sales minus variable cost contribution margin. Last semester, sales minus cost of goods sold equals gross profit. It's two different statements. Now what's interesting about these statements is that one of you asked me a question earlier, does net income have to be the same in both approaches? I don't know, who of you asked, one of you asked me that, do you remember?
We were to discuss.
And I said no. I said net income does not have to be the same in both these approaches, but I'm not going to discuss it then, I'm going to discuss it later. Well, here we are. We're at the chapter where we're going to basically tell you why net income doesn't have to be the same in both approaches. And it's really rather simple. I mean, I think I can describe it to you in a very simple way, and then we can go through it. Under the contribution margin approach, all fixed manufacturing overhead is treated as a period expense. That's an expense. There's no attempt to allocate fixed manufacturing overhead to the units of product, the way we've been doing it in this last chapter. We simply treat it as an expense and along with fixed selling and administrative expenses. All lumped into fixed costs underneath the contribution margin number. So, in contrast, the approach we learned last semester does indeed take a share of the fixed manufacturing overhead and allocate it to the products as part of inventory. So that could lead to a difference. In other words, under the approach that we learned last semester, it was called, we're going to actually give a name to it, it's called absorption costing. Under absorption costing, you're required under GAAP to include a percentage, especially in a manufacturer, to include some of the fixed overhead along with inventory. So let's say, for argument's sake, we produce 1,000 units and we only sell 800 this period. This is our first year. Keep a nice simple example. First year, we produce 1,000 units and we only sell 800. So 200 units are going to be left in ending inventory, correct? Those 200 units are going to take approximately 20% of the fixed manufacturing overhead with them into the asset category. They're not going to be treated as an expense. Remember, fixed manufacturing overhead has to be allocated to those inventory units.
Until next year when you actually
When you sell it, that's right. In contrast, in the approach that we're learning, the one that deals with the contribution margin, the whole fixed manufacturing overhead is deducted in the same period. There's no attempt to allocate it to inventory. It's all treated as an expense. So you can see under those conditions, when production and units sold are not the same, that could lead to a difference in the different categories, in the different statements. Let me start with the intuition of that. Does that make sense? That's really what a lot of this chapter is about. I mean, it seems like a much more complex chapter, but it all comes down to the fact that if you don't sell everything you produce, then some of that fixed overhead will not appear on the income statement under the old approach.
The only thing that doesn't make sense is that if you then apply those costs to the next period when you actually do sell your inventory, it looks like you were able to produce more than you actually really could. Meaning it looks like your labor was increased,
Well,
like your capacity.
well, let me just say this to you. I don't know, this may not be precisely what you're thinking, but this is related to what you're saying. In a period when they sell more than they produce, which I was pretty much giving you the scenario where they sell less than they produce, you're selling, so I want you to put your thinking cap on here. So, again, you're in year one, and we'll go through this, by the way, very carefully in a minute, but I want to see if we can verbally understand this. Call it an experiment on my part. See if I can verbally teach this to you without going to the board. Over the phone. Okay, so, okay, let's make it simple. The fixed manufacturing overhead is, let's assume that it's allocated to the products based on a certain amount per unit, just like we did before. And keep it simple, year one, we talked about it. Let's say there's $3 of fixed overhead allocated to each product. Every year you produce 1,000 units, to make it even simpler. So you have 2 years in existence, each one producing 1,000 units each. The first year, and each one has the same exact fixed overhead per unit. Same 1,000 each year. Year one, you sell 800 units. Year two, you sell 1,200 units. $3 per unit. I guess I can even say it simpler. It's $3 of manufacturing overhead. 1,000 to 3,000 is $3. So it's $3 of manufacturing overhead per unit. And 1 year, and so it's 1,000 units produced each year. Year one, they only sold 800, but year two they sell 1,200. That's the scenario. Now,
Is your 1,000 units, your production of 1,000 units at capacity?
it doesn't change the answer, but let's assume it is. Doesn't matter. It won't matter.
Like FIFO, LIFO?
Same cost. We're not getting into the different forget about inflation.
Same fixed costs.
Same thing every year. What is the difference? So year one and year two, tell me the difference between the net income under the contribution margin statement versus the traditional, what we call absorption income statement. That information alone is sufficient to tell you the answer. Everything else will be the same. This is the only reason there'll ever be a difference between these approaches. Everything else should not be different. Because under both approaches, you're doing pretty much the same thing, except for this one item. That's the only difference between the old approach and the so-called new approach.
There's gonna be a $600 difference,
Okay, so here.
right?
Okay, so the first year, the net income under GAAP is gonna be less than the net income under,
So we have year one, we have year two, and we have, I'm going to call this, old and new, right, for lack of a better word, okay? Old approach, new approach. Old approach, which we call absorption costing, new approach, which is the approach we use now, having to do with contribution margin. So the question I'm asking you, tell me the difference between these two approaches in these 2 years. So in year one, here's the information. Produced, sold. And the MOH per unit. So produced, we sold,
We produced 1,000.
we produce 1,000 each year.
We sold 800.
So in year one, we sold 800. In year two, we sold 1,200. So, with this information, tell me the difference in net income between these two approaches. There's no other reason for the difference. This will drive any differences. This single thing will drive any differences.
net income is gonna be less on new.
Okay, so you're saying by how much?
It's gonna be less, per unit, it was $3, so it's $3 times the number of units that were sold.
Okay, so the old approach will be therefore higher net income or lower. It will be, Julie, the old approach will be higher or lower than
Then the new approach,
the old approach will be higher is indeed correct. Absolutely. Why? Well, because
you
the
put
new
the money
approach,
back in.
the new approach is taking 1,000 times 3 and treating it as a period expense in total. The old approach is basically allocating overhead to the units. So 200 units, they produced 1,000, 800 was sold, that leaves 200 left in inventory. Those 200 units in inventory will carry with them $3 a unit, not including the income statement. So, therefore, $600 difference in favor of the old approach. So old is greater than new by 600. Old is going to be, the old net income is greater than the new net income by $600, which is equal to 200 units times $3 each. Again, I'm going to go through this carefully with you, but again, this is call it an experiment. I want to see if I can. It seems like to me, it seems like a straightforward concept, but it's easy for me to say that because I understand. I want to make sure that if I can teach it to you in a straightforward way, we're going to go through it anyway. But so now, so basically, old is greater than Y because the intuition is the old approach kept 200 units into ending inventory, which carried with it $3 a unit or $600. So that became an asset. Whereas the $600 under the new approach is an expense. So what happens in the next period? It reverses. Now, they've sold, not only have they sold this amount, but they've also sold the 200 that was in inventory last period. So it just reverses. The new will be greater than the old by $600. It just reversed. Why? Because the new is only deducting the period expenses of 1,000 times 3 or 6 or 3,000. That's the new expense. The old expense is going to treat 1,200 units times 3 as the expense of 3,600.
And the 600
Cost of goods sold, that'll be part of cost of goods sold under the old approach. So what's driving this, and it's the only thing that's driving these differences between these two methods, is what happens to the units produced that are not sold. They take with them some of the overhead as part of the absorption costing approach mandated by GAAP. Under the new approach, we don't care about that. We treat every period's manufacturing overhead as a deduction in that period. We don't defer any of that in any inventory. It all becomes an expense in that same period. So that leads to these differences. That's really what a lot of this chapter is about. Okay, so let's go, now that hopefully you see this, and if you don't, we're going to go through it again. Let's take a look at this chapter. That's a lot of what this chapter is about. Reconciling the difference between what I call the old approach, absorption costing, and the new approach, which we call the contribution margin. All right, so here's another example for you. I'm jumping right ahead to a later slide. That's all I think we need. I'm really trying to focus on what I think are the concepts I want you to understand. So here's an example. I want you to so let's see if you in fact, this is now I threw this example at you. Let me see if you understand it. Let's work through this problem. Let me just make sure the next one. The only question I want you to answer, though, is not the one they're asking. Tell me the difference. No, tell me the difference between the absorption costing approach in each year and the variable costing approach, which is another name for the contribution margin income statement. Just tell me the difference in net income between these two approaches.
Sorry, what?
I want you to tell me the difference in net income between these two approaches.
Wait, repeat the other terms you used.
Okay, 1 second. Give me a second, guys. Well, let's put it this way. Let me go through it with you, but ultimately the thing to keep in mind is what I said earlier. Well, the most important thing you can learn is what the differences are, because that's ultimately what this is leading to, is reconciling these two. So here's the traditional information. So let's go through the standard approach. This is the information. If you would take it down, if you don't mind, let's work through it.
Direct materials, labor, manufacturing overhead per unit.
Yeah.
Per unit.
So 25,000 years, they produce the same amount each year. Let's notice the variable cost per unit is 10, and the selling administrative cost, the variable is 3. Fixed cost per year is 150, selling administrative is 100.
In addition to the,
Yeah, so,
But you haven't used the
Selling
term
and administrative.
absorption. Can you explain that?
yes. Absorption is the method required by GAAP that insists that fixed manufacturing overhead get allocated to the inventory units. So some
Period
share,
that it was produced.
yes. So some share of fixed overhead has to be by fiat. By fiat, has to be allocated to the units produced. It's not an option. You must do it. The term itself implies it. The units have to absorb, every unit you produce has to absorb some of the fixed manufacturing overhead. That's not discretionary in the American economy system. Yeah. My guess it's also true all around the world. I think that's a standard requirement. Okay. All right, make a note of these numbers if you will. Okay. So far, so good. Here we go. So notice that they're coming up with a fixed manufacturing overhead cost per unit, which is what I did basically, $6 a unit. $6 a unit. So you'll see pretty soon where we're going, I hope. Notice.
oh wait, how'd you get to 6?
Did you hit 6?
Oh,
Okay.
for the just the fixed part.
Yes, for the
Okay.
6, it's 150 divided by 25,000.
150 plus 100.
No, we're just coming up with a fixed.
Oh, just the manufacturer. Okay, fine.
Sure. The so-called variable costing approach, notice, why don't they come up with a rate for variable costing, under the variable costing?
Because it's already.
Guys, notice there's no rate here, why not? This I've been calling the new
Because it's
approach.
variable cost.
They don't,
Because it's fixed.
because they don't allocate it to the units. There's no need to come up with a cost per unit. They treat the whole cost as an expense in that period. So in the absorption costing world, we're going to have to come up with a overhead cost per unit. In the variable costing world, we're treating the whole thing as a period expense. We don't need to. That's the reason. So let's keep moving, but I wanted to at least make it clear. So this is only relevant in this approach. All right? Can I move on?
Yeah,
Questions?
I just don't understand it from a managerial accounting perspective. How is variable costing way relevant? But because you're missing out so much stuff on only your fixed expenses.
Good question. Under variable costing, their view is fixed manufacturing overhead should not be allocated to the product. Should not be. We should, because it's not directly related to the production of the product. There's a nebulous kind of cause and effect relationship between production and fixed overhead. It's by its very nature, it's an arbitrary allocation. So in the managerial accounting world, let's treat fixed manufacturing overhead as a period expense. Let's not make the fallacious attempt to allocate it to the products. There's no logic behind it.
And how can you hope to ever decrease it if you're not looking into it?
I'm just telling you, asked me a question, that's their philosophy. Okay. Their philosophy is not, let's not attempt.
My company, we're not running this, right?
Okay, but anyway, you asked me, I'm telling you, that's the reason, okay? They view fixed overhead as just like fixed selling administrative. Let's deduct it and get it. The careful managerial accountant is looking for ways to figure out the cause and effect relationship between production and costs. And if there's no relationship, then the managerial accountant is tempted to say, and let's just treat it as a fixed expense, because there's no attempt to use a decision or any kind of control. It's there every year. It doesn't change. Whatever I produce is not going to change that number. So
It's more like looking at it as a sunk cost.
yes, more or less. Yeah, it's not something we can control. Okay, just to answer your question, that's the way they look at it. Okay.
So the old is the same as variable?
Yes. No. The old is absorption. That's the approach where they have things like cost of goods sold shown on the income statement. And the difference, though, is that this semester we are looking at a manufacturing company. We didn't. So
I thought you said that that in absorption, each unit has to absorb the cost.
that's what it is. That's correct.
But isn't that the new method that we're supposed to do?
No.
I'm so confused.
No. We've been focusing on methods that firms are using in practice to allocate overhead to the products.
Right?
And I said to you that that's required both for financial accounting purposes, and some companies use it. They try to use it for decision-making purposes. We're going to get to a later chapter which tells you that's not the way to do it. So hang in there in terms of the best way to do things.
I don't understand what I said.
Well, absorption costing, I think all you need to understand is that absorption costing, if you see these two methods, the question right now is why should there be a difference between the two? And let's just focus on that as a single question right now.
Okay.
You know, whether you think this is a good way or the way that we've been seeing with job order costing is a type of absorption costing approach. Because fixed overhead is being allocated to the product.
Right.
So we have been looking at the traditional approach in chapter 4. There's no question about it. And now we're looking at the traditional approach and we're comparing it to the new approach. And this is why we're looking at how to measure any differences between the two. So let's just stick to that one point for the moment, okay?
Can you just clarify what you mean by new approach?
New approach is the contribution margin approach,
Right.
which both basically looks at things like contribution margin. It's where we have, just to go take you back,
But didn't that approach take into account some of the fixed costs?
it's sales minus variable cost equals contribution margin minus all fixed costs, including that fixed manufacturing overhead. None
So
of
it's in there.
sure it's in there, but it's treated as a period expense.
That's good. Is but the product specific fixed cost that's excluded as well.
The only cost that's focused on in the variable costing approach is we start with again. Let's just remind ourselves. We have the sales minus variable cost equals contribution margin.
Right.
So think of it above the line. You have variable cost is the critical factor. We're trying to figure out contribution margin ultimately. And why? Just to remind us, why are we focused on contribution margin? Because we treat fixed costs. Take you back to what I said a few minutes ago. What is a managerial accountant? He or she looks at fixed costs as we have to figure out a way to get over these fixed costs. We can't avoid them. So we have to sell enough units, each one contributing a certain amount per unit to get over the hump. Remember I said that?
Right.
So all fixed costs, not just the selling administrative, fixed costs including the manufacturing overhead costs that are fixed are also treated in that same.
But that's what I'm saying. Essentially, doesn't that absorb some of the fixed costs?
No.
What?
The units are not.
Like you have to figure out how much of the contribution margin can go to cover your fixed costs, right? So you have to know if you're going to produce enough and sell enough bicycles to give you a contribution margin that will help cover your fixed costs.
Right.
So essentially, doesn't that contribution margin take into account your fixed?
No, it doesn't.
Not the
Sales minus variable cost.
Itself.
Sales minus
No, I
variable cost.
understand that, but-
Sales minus variable cost.
But in order to know how many bicycles you have to sell,
Right.
you have to know what the contribution margin is and how much of the fixed costs you have to cover with it.
That's right. But that doesn't change the fact that the new approach doesn't allocate fixed overhead to products. The new
It's just
approach
separate.
treats it as a separate line item as an expense.
But what else would you be covering your fixed costs with other than what your products are?
That doesn't, everything you're asking is all you're not, the question is, we're looking at two different styles of income statements, right? Let me just put them up here, just to make sure we're understanding this.